Welcome back to the Longacres Finance channel. If you've listened to some of my recent content, you likely already know that I am a fan of Skyworks Solutions. The company recently released their fiscal quarter 3 earnings results, and I wanted to share some of the news from the earnings report as well as the earnings call with you today. I've already shared my thoughts with my Patreon community, so if you're a member there and you had a chance to read my thoughts, this episode may be a little repetitive. Part of being an active investor in individual businesses requires some due diligence. I personally try to look at earnings results for all of the companies I am invested in. Most of the time, I just do a cursory review, but sometimes I will dig a little deeper, especially for my highest conviction stocks. And Skyworks is one of them. I really like this company, and I believe they have a bright future. So today I want to talk about their most recent results and guidance for the future, as well as show you my updated valuation for the business. If you don't know anything about Skyworks Solutions, they are essentially a semiconductor business that services many industries, but the bulk of their revenue is from the mobile market. Skyworks is a leader in the shift to 5G and has been able to benefit greatly from the mobile industry's move into the space. Pretty much all of the large phone manufacturers use Skyworks RF devices, and this demand should continue in the future. The company invests heavily into innovation and has proven to be a leader in the space. Overall, fiscal quarter 3 results were positive. The company reported record revenue of $1.23 billion that beat analyst consensus and was 10% higher compared to last year. The growth was primarily driven by 5G-enabled devices, along with automotive, data center, and network infrastructure sectors. There was some good news for dividend investors as well, as an 11% dividend increase was announced with the earnings results. This was the 8th consecutive increase for the company, with the new dividend rate going into effect with the September 15th dividend payment. Additionally, the company provided strong guidance for the next quarter. Management is expecting revenue to grow by 14% and earnings to grow by 19%. Very strong growth rates to wrap up the fiscal year. Fiscal quarter 4 is typically strong for Skyworks, as this time of the year is a popular time for the release of new mobile devices. The one caveat in the most recent financials is a drop in the free cash flow. The reason for this small decline is primarily due to the company increasing their inventory to offset potential supply chain issues and some investment in property, plant, and equipment. From a valuation standpoint, I believe the company is still attractively valued on the market, but I'll dig more into that a little bit later. The biggest risk for Skyworks is customer concentration. If you don't know, Apple accounts for about 55% of total revenues, and should this relationship be impacted in any adverse way, it may mean trouble for Skyworks. The risk here is twofold. 1, a competitor could take away market share from Skyworks. And 2, Apple could bring the design and manufacturing of RF devices in-house. I don't think either scenario is likely, at least in the near future. Skyworks is an industry leader with a big focus on innovation, and as a result, they offer some of the best products on the market. With the design and manufacturing being done in-house, it will be difficult for a competitor to duplicate Skyworks technology. Apple does have a history of developing their own components, with the most recent shift from Intel's processors to the in-house M1 and M2 processors designed by Apple. However, I think a major reason for this change was the lag of innovation from Intel, as many of their competitors seem to be moving quicker. Skyworks, on the other hand, has a lot of know-how and is a leader in the RF device space. It would be difficult and maybe not financially beneficial for Apple to design and manufacture RF devices in-house, and to do it better and cheaper than what they currently get from Skyworks. Nevertheless, the customer concentration risk remains elevated and is unlikely to go away anytime soon. Skyworks does have other segments they service and a robust list of customers. One of the more interesting spaces is the infrastructure and automotive business that was acquired from Silicon Labs. During the earnings call, management reported that the integration is going well, and initial results have been above expectations. This acquisition was anticipated to provide growth of numerous segments for Skyworks, and I am optimistic to hear more on this from management in the future. And finally, onto the bad news, which to be honest is not that bad at all. Given the most current trailing 12-month financials, my valuation of the business has trended lower, but the company still remains attractive. And most importantly, I believe after the fiscal year is over, my valuation will revert back to previous levels or even higher. When I provided this update on my Patreon page, Skyworks traded for $112.50. Today it trades slightly lower, around $109. This gives us a forward dividend yield of 2.28%, with the 5-year trailing dividend yield being 1.43%. So from a dividend yield perspective, the price of Skyworks still looks very attractive. Dividend yield theory tells us the share price is about 37% undervalued. The way I computed this is I take the dividend rate of $2.48 and divide it by the trailing dividend yield of 1.43%. This gives me a fair price for the stock of about $173. Comparing the current price of $109 to the fair price of $173 tells me it's about 37% below fair value. Given that dividend yield theory is a rather quick and dirty valuation technique, I also like to value a business from a free cash flow perspective, because as a smart man once said, a business is worth the amount of free cash flow it can produce in the future. Before the latest financials were released, I had a price target of $128 to $129 on Skyworks. At its current share price of about $109, the stock looks about 15% undervalued. Not as much as dividend yield theory is suggesting, but still a good bargain. Here's how the valuation has changed with the latest update. Cash from operations has declined from $1.6457 billion to $1.5866 billion, and CapEx has increased from $600.5 million to $610.7 million. Combined, this results in a 6.6% decline in free cash flow. Offsetting this reduction in free cash flow is the reduction in the number of shares outstanding. In fiscal quarter 3, Skyworks reduced its share count from 166.3 million to 164.9 million, which is a little bit less than 1% change. Putting this all together, the free cash flow per share drops from $6.29 to $5.92, or about 5.9% lower. Based on the new lower free cash flow per share, the new valuation for Skyworks is $121 to $122, or 5.5% less than the prior valuation. On a positive note, shares of the stock are still trading below this level, but the potential undervaluation is about 10%, and not 15% as suggested before. To me, it's still an attractive deal, and I also believe the company will post very strong results in quarter 4, and I expect the valuation to jump back closer to $130. I don't know why the price of Skyworks was driven so low this year, but I am happy that I am able to grow my position at what I believe is a discounted price. This is just my opinion based on the research I have done. I am not trying to convince anyone to invest in the stock. You must decide whether this company fits your portfolio, and at what price the stock makes sense to you. I hope you enjoyed the video. If you did, please give it a like and subscribe to the channel. Thank you for watching and see you next time.